On All About Stocks this week, the Sensex falls nearly 350 points on Friday. Is this correction the opportunity we needed to start buying stocks? Our investment advisor Hemang Jani builds a brand new portfolio for the next 5 years. He picks out themes that are going to play out going ahead. Welcome to All About Stocks. This is a show for long-term retail investors where we'll tell you how to use the stock market to get rich over the long term. As ET now turns 5 years old, on the 17th of June, we have a very special episode planned out for you this week. Now, when the change happened at the centre, a lot of the expectations on the ground changed as well, especially on the Lal Street. People are expecting अच्छे दिन for the next 5 years. We've in fact decided to build a brand new portfolio for you, taking advantage of the things that have changed, the sectors that have turned around and the themes that are currently in focus. Stocks that you can buy right now that will make you rich over the next 5 years. In fact, we have a very special guest in the studio today, Hemang Jani, who's one of our most successful advisors so far. Hemang's portfolio that he designed for us is one of the best portfolios we have on the show, which is why we've asked him to come in and design this portfolio for us. So over the next half hour, grab a pen and paper, write down the stocks and the themes that you hear during this show. Remember, any portfolio we design on the show, we continue to track for you, so we'll tell you how it's doing as well. Email ID is at the bottom of your screen if you want to send in any question about the advice you hear on the show. Let me first bring in Ajay to give us an update on all of the action on the Lal Street this week. Ajay, take it away.
Well, Faye, optically, it may look like it's been a week of average losses of just about 0.5% as far as the benchmark indices are concerned. But bulk of the weakness actually came in on Friday alone, when geopolitical risks accelerated at the horizon, especially with conflict in Iraq. Mid-caps fell much more than the large caps, about 2% thereabouts, the kind of cracks we saw in mid-cap indices, but large-cap stocks, mainly from policy-driven areas of, say, real estate, PSU, all of that corrected very sharply this particular week. If you look at fund flows, FII remained buyers, but we also saw selling from DII side accelerate, and the way mid-caps were cracking in trade this particular week and Friday in particular, we saw that perhaps HNI and the retail community, which was very active in this side of the market, has also been booking profit. Going forward, of course, people would like to say how the geopolitical things really pan out from here on. Things are extremely sensitive as far as Iraqi situation is concerned, and especially the issue of the way rupee has started to weaken in the last 4 days has also taken a lot of strategists by surprise. However, a lot of missed out feeling was already there in the market, and one end of the retail investors really did not participate in the very sharp rally we saw in all these policy sensitive stocks. This market is becoming healthy for at least that side of the investors. Most of the analysts are also indicating that from here on, if the market continues to weaken a little more, those people who did not participate in the rally should start looking for quality stocks. Special emphasis is being paid to to be buying quality stocks, not low quality mid caps in the real estate, PSU pack, and even defensive such as IT is not being ruled out to be bought in this particular bout of weakness.
All right, Ajay, thank you so much for that information. Like Ajay was telling us, Hemang, Friday was quite a beating. But is this the opportunity that investors have been waiting for? Because this run-up has been so quick, it hasn't really given a retail investor the opportunity to get back into this market.
Yes, I think most of the retail investors have been waiting for a correction which was actually not coming through, and finally we have seen it happen today. I think it's important and healthy for the retail participants, because once you see about 25, 30, 40% up move in certain pockets, it's important that you look at the valuations and you look for a better entry point. So I definitely think that overall sentiment is definitely positive. Overall trend of the market is definitely up, and it's good that this correction has come in, which would help retail investors look at some stocks and buy over a period of time.
Well, a lot of the reason why we asked you to design a portfolio today is because we're getting a lot of questions from viewers asking us, is power ripe for the picking right now? Should we start investing in power, infrastructure, PSU stocks, banking PSU stocks, in fact? And there is a need right now to address all of these questions, which I think would be best served if we designed a portfolio. But tell me about the sectors that have fallen out of favor so quickly, like pharma, like consumer goods or consumer stocks that are no longer in focus. IT, for example, is being shunned a little bit by the street as well. What should we be doing if we already have these stocks in our portfolios?
Well, definitely, if you have a portfolio, it's important to have a diversified portfolio or a balanced portfolio, and where definitely there has to be some exposure to sectors like IT and pharma, because over a period of time, we have seen that these sectors, and particularly certain stocks in these pockets, have delivered extremely good returns, and even the performance would continue to remain good because globally things are looking quite upbeat. But the fact of the matter is that because certain pockets were out of flavor for a long period of time, and now that the economic revival cycle has begun, we have a new government at the center, there is a lot of optimism. So if you have a capex cycle, kicking in a big way, then certain companies in the infra space or power or road or utilities would start giving you much better upside potential because of the better valuations. So to take advantage of that, we should have a slightly higher exposure towards those pockets, including financials.
All right, let me give you a list of stocks in Hemang's portfolio that you can write down. Right on top, L&T, Ultratech, VA Tech Vabag, Container Corporation, Engineers India, Coal India, Oil India, ICICI Bank, SBI, LIC Housing Finance, Maruti, M&M, Tech Mahindra, TCS, Sun Pharma and MCX. My first question, Hemang, about this portfolio is the number of stocks in this portfolio. It's 16 stocks. So we normally talk about the fact that you should keep your portfolio nimble so that you can manage all of the stocks and you can research all of them. Tell us why there are so many stocks in this portfolio.
Well, we have about 16 stocks in the portfolio, and I am trying to play about 2 or 3 important themes. So, we wanted to have about 2 or 3 stocks within each theme that I'm trying to look at. And at the same time, we cannot totally neglect, the defensive ones, particularly IT and pharma, as I said before. So overall, we have about 16 stocks. In a typical portfolio of a retail investor, we could have, stocks anywhere from about 12 to 16. Too less makes it very risky. Too many of them makes the tracking difficult, and the performance may not be that great.
Well, I want to ask you specifically about Coal India. You've allocated 5% to Coal India. The stock has nearly doubled in the last 3 months. How much more steam, no pun intended, do you expect Coal India to have going forward in the next 5 years? Where do you see that stock going?
Well, there's definitely a case of re-rating. Definitely from the bottom, it looks quite, impressive, about 80 to 100%. But the fact of the matter is that it's the largest coal company in the world. A lot of policy decisions are likely to be taken over the next few months. And if you have incremental production coming through, and if the capex cycle begins, then obviously the growth is going to be humongous. The overall operating margins could see uptick if they start getting the better realizations for the coal that they manufacture. So I think about 25-30% CAGR over the next 3 to 5 years is pretty much possible.
So just pulling from that, anybody who's watching right now who has Coal India in their portfolio and have been thinking, oh, I've made a good profit, I should take money off the table, you'd advise against that right now?
I think it makes sense to definitely hold on to that one because there's a long way to go. And if you get some corrections like what we've seen, it would be a great opportunity to enter into it. Very
conspicuous in its absence in your portfolio is the power sector. You have Coal India, but you don't have power stocks. Is there a reason why you've avoided them?
Well, no specific reason, but I believe that L&T, has some kind of a, pocket within the company which looks at the power and switchgear and related sector. So I think you have the best company within that space. So I have not added any other specific power generating company in the portfolio.
Also, we must talk about SBI. The view on SBI over the last 6-8 months was very glim, and now the stock again has recovered quite smartly. Do you see all of those concerns of NPAs and bad management? Do you think that will sort itself out over time?
Clearly, if you look at the performance in the last about couple of quarters, we've seen some positive surprises on the slippages front. And if the economic revival happens, then a lot of issues fade away. Like we've seen Suzlon and some of these companies which were reeling under debt pressure. If you see their prices have started doing much better, the money conditions have improved, so they can raise money from the domestic market as well as global markets. So that would ease off the pressure of NPLs, and more importantly, the bank per se will feel more confident. There's a change of management. If there's economic revival, you start disbursing loan to the corporates, and there's going to be a good growth going ahead. So we are extremely positive on the PSU banking space from the next 3 to 5 year perspective.
Why SBI and not a smaller bank or a mid-cap bank?
Well, I think that when there's a downturn, the smaller banks are not able to withstand the pressure, and if you look at the quality of assets for some of the smaller PSU banks, it's not been that great. SBI, with its balance sheet size and a better quality management, would be in a much better position to do that. And if you look at it from FI perspective, still the FI limit is available, and they prefer the large banks compared to the small banks. So I think that gives us stability.
ICICI Bank instead of Axis?
Axis has run up quite a bit. So I think that from a valuation standpoint, ICICI is looking better. Also, they have an insurance arm which is doing much better. So if you have some important reforms on the insurance front, then ICICI is in a better position to take advantage of that.
For anybody watching right now who's going to think, oh no, what do I do with my Axis Bank stock right now? What should we do with Axis?
Well, definitely it makes sense to hold on to it. But if I have to put incremental money at this point of time, then I would prefer ICICI because of the valuation comfort.
LIC Housing Finance, why is that in the portfolio?
LIC Housing, because we think that some of these NBFCs, there was some kind of a slowdown, and the valuation-wise things were looking much better. So if there is going to be some kind of a revival in the housing sector, then with this kind of a good quality management, the capital adequacy ratio being so good, I think there is going to be a re-rating of these NBFCs going forward. And within that basket, we think the LIC Housing Finance looks the best.
Well, one of the key themes in this portfolio is the PSU re-rating. Now, as the government's PSU plan plays out, tell us which stocks in this portfolio do you think stand to gain the most?
One of the themes is going to be oil and gas theme, because we are going to see more reforms on that particular front with respect to subsidy, the better realization for the gas. So one of the companies that we have included in our portfolio is Oil India. Apart from that, if you see, the entire thrust of Narendra Modi in the past has been improving the infrastructure, putting up a good railway freight corridor. And we think that given the strength that Container Corporation of India has and the kind of traffic growth that we are seeing, particularly with respect to the port traffic, we think that this would be the biggest beneficiary of that. And finally, if there is going to be a huge investment in the oil and gas pack, then somebody like Engineers India, which is basically acting as a consultant to the sectors like power and oil and gas, they will get a good visibility of the capex cycle. So I think these are some of the companies that would benefit from this entire space.
All right, and finally, L&T, right on top on your list, 8% allocation. Tell us what you expect from the stock going forward.
Well, the thing that I like about L&T is that they are extremely good at handling the downturn, and they have a fairly well diversified exposure to different sectors of the economy. So we think that if there is going to be an uptick in the domestic cycle, then this particular company will do well. Also, they have a good amount of exposure in the Middle East area. So we have a couple of events coming up in Dubai Expo 2020. Also, Qatar, there is going to be a FIFA World Cup. So with that kind of events coming up, there is going to be a good growth from their overseas projects. So we think that overall growth here is going to be more than what the management has guided for, about 15 to 18%. So I definitely think that it will do extremely well.
I'm going to give you a list of Hemang's portfolio one more time so you can write it down. L&T, Ultratech, VA Tech, Vabag, Container Corporation, Engineers India, Coal India, Oil India, ICICI Bank, SBI, LIC Housing Finance, Maruti, M&M, Tech Mahindra, TCS, Sun Pharma and MCX. Welcome back. You're watching All About Stocks on ET now. Hemang Jani is still with us, helping us form a strategy for our long-term portfolios. We have some questions that have come in during the week. V. Santhanam has written in he has 250 shares of 3i Infotech, which he bought at 69 rupees. He wants to know if we should continue holding on to that stock. The stock is currently at about 12 rupees and 45 paise. So he must have bought this stock at this price around 2010, I think, because it hasn't been at those levels for a really long time. What would you recommend he does with it?
Well, if you look at the performance of this company, it's not been that great. And within the mid-cap space, I think something like a First Source Solution, which is quoting at about 33, 34, is under our coverage and is looking much better. So he can actually switch from this company to FSL.
All right. Unfortunately, you're going to have to cut your losses on that one. Shrikant has written in 290 shares of Motherson Sumi, bought at 265. Should he hold on to that stock? Now, the stock hit an all-time high recently. For someone like him who's holding on to that stock now, he's looking at it make profits for himself. How much more can he expect, if at all?
Well, it's looking pretty impressive. I think globally things are looking pretty up, and this management has guided for a growth of about 20-25% next 3 to 5 years. So we think that he can easily hold on to it. I think he can look for about 25 to 30% appreciation even from current levels.
All right, we have a question from Chinmay who's written in 60 shares of SAIL bought at 47 rupees and 68 paise. Should I hold on to this? There's been a big run up in this stock. It ended the week at about 96.95. There's been some problems in one of their plants, but tell us about the entire steel sector, which has come back into focus. But first, tell us about SAIL. Do you believe it's a stock that's going to continue to benefit from the government's programs, and should we hold on to it?
Well, things are looking up. If you look at the global scenario, the data coming out from China, it's been pretty encouraging. Only thing is that recently they have done an increase in the salaries, etc., which is going to cost them about 1,000 crore annually. And there was some kind of a mishap at their plant. But overall, we think that valuation-wise, it's still looking attractive. There's about 25-30% upside even from current levels.
See, one of those sectors that we saw come back into focus with this run-up was the steel sector. We saw Tata Steel, JSPL, everybody come back into focus. If I were to ask you to choose right now, based on valuations and opportunity within the steel sector, which one would you find most attractive to buy?
I think both Tata Steel and SAIL are looking impressive. Tata Steel is more of a global play. Even their things are looking much better. And SAIL would be a domestic play. Plus, it's a PSU tag. So there's some kind of a re-rating that we are seeing in that space. So we think that both the companies are doing pretty well. Valuation-wise, SAIL is looking even more attractive.
Question from Arpit, who's written in 100 shares of Gujarat Gas at 382 and 50 shares of Oil India at 570. He wants to know if you should hold on to both of those stocks. Well, Oil India you mentioned in your portfolio, so obviously you want him to hold on to it at this point?
Absolutely. I think there's a long way to go. It's available at about 35 to 40% cheaper than the global peers.
What about Gujarat Gas at 382?
Gujarat Gas, overall, we like the company. They have a good infrastructure, particularly in Gujarat. And we think that if we have a major focus on it and there's going to be a huge infrastructure opportunity, then this company would stand to benefit. Plus, there was some kind of an open offer, if I recollect correctly. So there is some kind of a base which has been built in for this company.
All right. I also want to very quickly ask you, since we're talking about the oil and gas sector, I want to ask you about the other stocks, the big ones, the ONGC, BPCL, HPCL right now. When you look at these stocks and you look at the fact that this government has been fortunate enough to inherit a pricing policy where diesel prices are on their way up, where it's okay to continuously increase these prices. They're looking at possibly increasing the prices of, cooking gas as well. Where do you expect to see all of these stocks go, and how do you expect this pricing policy for oil and gas to play out in the country?
Clearly, we have indications coming out from the government that diesel price could be actually decontrolled in the next about 1.5 years' time. That would be a big, positive trigger for the oil marketing companies. And we think that if finally the subsidy part is taken care of in a transparent way, then obviously there is going to be a big upside potential for some of the oil marketing companies. So something like ONGC, BPCL, HPCL, even Oil India, I think there's a long way to go. I think if you have a 3 to 5 year perspective, then some of these stocks could be multi-baggers. So we should have exposure in this particular space. Yet
somehow you picked Oil India in your portfolio. You haven't picked the other three. Can you tell us why? What are the risks there with the other three stocks?
There's no risk, but if you're creating a portfolio, then you have to look at the best possible stock within that pack in terms of valuations and upside potential. So I feel that Oil India looks the best in terms of valuations.
Haren has written in, he wants to buy Pipavav Defence at current levels for the long term. Now, Pipavav ended the week at 62.50. It hit a 52-week recent high recently, but that's because of the announcements the government made about the possibility of FDI in the defence sector, and this stock obviously stands to benefit. How much further do you think the stock can go?
Yes, I think, if you have this kind of a development taking place, though, there is going to be some kind of an opposition also. But I think that in the current scenario, this stock is looking pretty good. There was a good amount of order inflow that we have seen in the last couple of quarters. So it's looking good for a decent upside.
Good time to buy as well at these levels?
I think that one should wait for budget because, there could be some kind of volatility around that time. And market also is in a corrective phase. So maybe about 10% correction would be a good entry point.
All right, time for us to take another very quick break. When we come back, we'll talk about stocks like NTPC and Ashok Leyland. Don't go anywhere. Welcome back. You're watching All About Stocks on ET now. Thank you so much for staying with us. Hemang Jani is still with us, helping us make money over the long term. Hemang, thank you for staying with us. We have Nishant Arora, who's our lucky viewer this week, who sent in his entire portfolio. We're going to take a look at his whole portfolio and tell him which of these stocks he should be holding and which one he should be selling. Right on top, 20 shares of NTPC, which he bought at 121 rupees. What's your call for someone like Nishant? Should he be holding on to NTPC?
Yes, we've seen some kind of uptick in this power utility space, and I think once we have a long-term FSA agreements being entered into by them, there is going to be a re-rating for these PSU, so it makes sense to hold on to this one.
All right. He also has 500 shares of MTNL, which he bought at 17 rupees. So he's making a decent profit on that one as well. Hold on to MTNL.
It's a risky stock. We don't know what kind of important decisions are going to be taken, but he can ride the profit as long as things are good.
He might miss that then. Does it make more sense then if you're saying it's a risky stock to move out and move into one of the stocks you recommended earlier on the show?
See, if he has a limited exposure, then, if we have some important developments taking place in the next couple of quarters, then it could re-rate the company altogether. So it makes sense to hold on to that one.
All right, so hold on to that stock. He also has 40 shares of Tata Teleservices, which he bought at 11 rupees. That hasn't moved too much from the levels at which he bought it at. What's your call on Tata Teleservices?
I think there's not much of clarity on the, this overall growth of this company, and it makes sense to actually exit out of it.
All right, exit out of that. Ashok Leyland as well, he's bought at 32 rupees. There's a lot of talk right now happening about the monsoon, the fact that we might not see it come in on time. It might, bring up inflation. It might, of course, affect our entire rural sector. How do you see this playing out for all of the companies that get affected by the monsoon, but this one in particular?
See, monsoon, yes, we have early indications that it may not be great, but the fact of the matter is that the overall dependence of our GDP on the agri is very little, about 14%, and only certain pockets get affected, so we should not get too much perturbed about that. And about Ashok Leyland, I think the fact of the matter is that about 3 to 4 years there was a downturn. Now we are seeing early indications of an uptick there, and this stock can easily give you about 40-45% kind of an upside from current levels, so you should definitely look at accumulating it.
All right, accumulate that stock. Lastly, he has 100 shares of Reliance Capital, which he bought at 428 rupees. Of all of the stocks that stand to gain, if there are, like you said, reforms in the insurance and pension space, how would you rate Reliance Capital, and does it make sense to hold on to it? Extremely
high beta stock. They don't have a very strong presence across the spectrum. So I think that if you really want to get into it, I would prefer something like ICICI Bank, which is far more stable.
All right, ICICI Bank, that's far more stable there. We've run out of time on the show. Hemang, thank you so much for joining us on the show. Remember, if you have a question for Hemang in particular about his portfolio or anything else he recommended on the show, write to us. Our email ID is at the bottom of your screen. You'll find a copy of the show on our Facebook page. You can reach me personally on Twitter. Thanks so much for watching.